So I think we're just going to clarify the term volatility just before we go too much further, as we only need to be on the same level of understanding. So volatility is really just defined as a statistical measure of the dispersion of returns for a given security or market index. At least that's how Investopedia defines it cleanly. And what does that mean for me as a trader investor though? Well, think of volatility as a measure or number to identify how large and how quickly a price will move. It's commonly used to describe the level of risk or amount of uncertainty of different investments. And volatility is usually shared as a number or percentage and represents the size of a deflection of price swing from where it normally is trading at. So the higher the volatility of an investment, the higher the risk and the greater the price variation can be expected over a short period of time. So say you're looking at two different stocks to buy that are trading at 50 bucks each. If stock A was trading ranging from $40 to $60 and stock B was trading from $48 to $52, then you would say that stock A is more volatile because it has a larger price fluctuation from its mean of 50. The stock market uses lots of different Greek symbols to measure many different metrics, and volatility is no different, and it is commonly referred to as the Greek term beta. So this beta, or volatility number, is usually compared to a benchmark. And for the US market, that's commonly set by the S&P 500 index as being a beta of 1. And suggesting that any securities with a beta that is higher than 1.0 means it is likely to fluctuate more largely than the fluctuation of the S&P 500 index. If that beta is lower than 1.0, then it is going to fluctuate less than the S&P 500 index. So let's talk about the different trader strategies. And we know that the different strategies create different trading opportunities. So if we consider that short-term trader suggests holding a security generally less than 2 years, then we can make sense of some of these different trader strategy terms. So because trading is considered short-term, it is really broken up into time durations and class based on that. So as an overview, I will share the different styles of trading, and you can eventually research any style you want. And there are really only two kinds of trades, short or long-term, except one style, which uses trends, which can be long or short-term. And that is momentum trading. And it's a trading strategy in which investors buy securities that are rising and sell them when they look to have peaked. The goal is to work with volatility by finding buying opportunities in short-term uptrends and then sell when the securities start to lose momentum. This is generally where most of Wall Street traders live. The next one is position trading, and that's really just buying an investment for the long term in the expectation that it will appreciate in value. And this type of trader is less concerned with the short-term fluctuations in price and the news of the day unless they alter the trader's long-term view of the position. Next, we'll look at swing trading. And this is a strategy that focuses on taking smaller gains in short-term trends and cutting losses quicker. The gains might be smaller, but done consistently over time, they can compound into excellent annual returns. Next is day trading. And this is the act of buying and selling a financial instrument or stock within the same day or even multiple times over the course of a day. And taking advantage of small price moves can be a lucrative game if it is played correctly. Scalping, that's a term for a strategy to prioritize making high volumes off small profits. So scalping requires a trader to have a strict exit strategy because one large loss could eliminate the many small gains the trader worked to obtain. K2 strategy does not follow just one of these listed because we use long and short-term trading strategies. And K2 is a blend of a few of these. K2 focuses using technical and fundamental analysis to determine when and what to trade. And trades are generally weekly or monthly in duration. And you'll see that the K2 strategy is conservative for starting into managing your own money. If you're used to using a mutual fund advisor, then this is a very nice way to ease into managing your own money without taking on too much risk. The trades you will learn in K2 will be your own strategy blend based on your own fundamental and technical analysis. So for understanding volume and timing, you'll generally be trading stock options on a weekly to monthly basis or time frame, and likely not more than a few trades per week. The more trades you do, the more time you require to monitor and manage them.